Good morning, traders. Welcome to a new week. As always, we start off with our fundamentals. What we're doing is we're just looking at key events, economic events that's going to happen this week that could produce a bit of volatility that helps us break through our trend lines or support resistance levels and whatnot. I want to make it as quickly as possible because there has been a little bit of movement on the markets this morning. And so it would be good to go over the technicals as well as a little bit of risk management and how to enter and or exit and enter your positions, specifically when there's we're hitting our key take profit or stop losses. So without further ado, this is Monday. As you can see, we are looking for economic events that will impact the US equities market. Over here, the only thing that stands out here is Trump and Xi Jinping, and that's a phone call. Again, it's probably going to last the whole day. It could happen anytime. Something may or may not come of it. It's nothing really, that we can hang our hat on. But if something does come out, just be aware that there could be something, but you don't really need to trade around it or anything like that. Again, let's just keep on going through. What we're doing is we're looking for the red dots on any economic calendar. Normally puts the red dots as the market moving events or the news releases. But we are looking for the US equities markets. That's France, Germany, UK. I mean, these are market moving, but not massive. Over here, we got the US S&P PMI flash. What this is, it's the S&P PMI essentially looks at the strength of economies. Anything above 50 is going to be expansive, and anything below 50 is contractory, right? So it's a good indicator. It does move the markets, but nothing like FOMC or anything like that. This is just more of a, the health of the economy. It doesn't point to anything specific like CPI or employment or anything like that, but just overall economic health. Let me quickly keep on going. Got Australia, Germany, don't worry about that. EIA inventory, if you guys like trading crude oil, that's what you want to look at. It's kind of like the commodities version of non-farm payroll, if you follow that. Then you got the BOJ minute meetings. That'll obviously be Japan. Don't worry about it. Swiss interest rate. Don't worry about it. US GDP. Now, these could be very market moving. Obviously, GDP is the gross domestic product. It's essentially what a country produces, right? It's the value of everything it produces. In terms of initial jobless claims, that's also going to be a big one, as well as the durable goods, also going to be a big one. So I think that is happening on Thursday. So keep an eye out for that. What date's that? 25th. Yeah, that's going to be on Thursday. So from Monday to Wednesday, fairly subdued. We can rely on the technicals as we start teeing up for economic releases. They all come out at 2:30 my time. This is Central European time. So just keep that in mind. US executing homes doesn't really have that much of an impact, to be fair. However, it does give you an indication of whether people can afford to buy homes. And it is an indicator, but just not a serious one. What we've got down here, then we got US PCE figures, your price indices. Again, this is 2:30 again on the Friday. So we can expect a little bit of volatility going into Thursday and Friday. Cool. So let's go through to our chart and have a look where we are. Okay, so this is Bitcoin on the daily, as we've been discussing for the last week. We made our way up. We had these kind of spikes, and we had like the close below this support resistance level, and you got these little wicks that went up and tried to test these levels. But again, we created that resistance from this bottom support here. It reacted to it nicely. It was coming down. As I mentioned on Friday, we can expect a little bit of a downside action, nothing too volatile. And then this morning, boom, we had this big reaction right into our ascending support line that we were looking for, right? So we did the same thing over here. We've had that line going up like that. Then we copied and pasted that, made it the bottom support of that channel, and then we have our support level that we're looking at. We had a target price of our short that we took over here of about 112200. So we took profit there, and I also had a order to go long just below that at 111,800. Okay, so that's took profit, then knocked me in. I will go through this a little bit later in terms of how to enter and exit these positions, because what we don't want to do is go down, we take profit, our account is now a lot higher because we've been leveraged, we've been short, took profit. If we are trading, say, 10% of our accounts, or 5% of our accounts, or 2% of our accounts, if we've doubled our account, it means that if we go in at that 2% or whatever allocation we have for that account size, we're going to increase our position size. We're actually going to double it. Whatever percentage you're trading of your total accounts, if you double your account, if you stick to that same percentage, you've now doubling your position size. We do not want to do that. Okay, I know that many people do it. I'm saying please stay away from that. It doesn't mean we cannot increase our position size, but when we go in, we have to go in at the same price that we were going down at, right? So let's just say we were short 0.005 Bitcoin. Now we weren't, we're 0.003 because we closed half of our position round about here, just after FOMC. So we were only short 0.003, and then we took profit over here. Now let's just say that we had the whole position. We didn't close half of it. It means that if we're going to be turning around, even though we've now doubled or tripled our accounts, we're only going to go long for 0.005. It needs to be the same as what we're going down, because it means that if we are wrong, we're losing money at the same rate that we made it. If we double our accounts and we're wrong, we're losing money twice as fast as we made it initially. So we only have to have a half a pullback and we will wipe out our accounts. Well, not our account, but we'll wipe out all the gains that we've had. So we want to ease ourselves into a position starting at a position size that was equal to our previous position. So let me show you here. We will enter, or we have entered 0.003 here. Now we've only got so much allocated. Maybe if it makes more sense if I take you over here. Now this is where the positions that we've closed, BTC short, BTC short. This is the BTC short that we closed. That was the half position that we closed. Then we closed the rest of it at 11220. We then went long, okay, for the same amount, okay, at 111,800. We've also gone long drift, but I'll show you that a little bit later. But the key is over here, right? Oh, sorry, over here. The account size is now, well, the size is now tripled, right? We're at $30 now. So that means that we are above this 28. Now what this means is that we started off with 10. Every 2.85 times of multiplier, we will then go to the next level, right? So before we get to 28.50, we're only going to be trading that $10. That $10 we spent purely on BTC, but because Drift, and I'll go into that now, had a very good entry price, we're going to split that up between 5 each, right? If we went in at 10 with BTC, and we also went in with another 10 with Drift, it means that we have now doubled our exposure. It's kind of, and it's the reason being is because all the altcoins are correlated to Bitcoin, right? So it's the same as taking a long position on sterling yen, sterling euro, sterling Aussie, sterling Kiwi, sterling dollar. All of those just before a UK CPI announcement or UK inflation announcement, right? What will happen is you can say, well, those are different currency pairs, but they're all denominated by sterling, so they're all going to be correlated. So effectively, you've, you know, times your exposure by 5, even though you've got different pairs, because you're still exposed to sterling on all of them, you've actually magnified your exposure quite significantly. So because we are, or because altcoins are correlated to Bitcoin, if we go long, all in on Bitcoin and all the altcoins, we're essentially all in on Bitcoin, but moving at different rates, have different betas. And obviously I went through that previously. So yes, we are now, our account is over that 28.5, okay? But we need to go in at the previous rate and get the same exposure and then work our way up to that position size. Okay, so how do we do this? We, first in, half of the position is 0.003. Okay, which means that we've got 0.002 left over. So that whatever we put in to take the position of 0.002, we can now allocate that to an altcoin. This is altcoin 1, right? So we got altcoin 1, 2, 3. Altcoin 1 is going to be Drift in this case. Okay, these can be anything. They can be Ethereum, they can be GRT, they can be Solana, whatever it is, anything other than Bitcoin. You don't want to have many altcoin positions. You want to take the top 5, 7, whatever it is, but you don't want to have hundreds of them, right? Rather pick the key ones. So we're going to max out at about 7 altcoins, and we're going to split that 10 between them. And then what we're going to do is we're going to add them later on. So let's go back to over here. We've entered there on Bitcoin. Let's go down to 30. We exited our position about there. We then got into our new position for the same size about there. Okay. We've let it go up. Now, when this comes down, we will expect this to go up, right? But what we want to do is make sure that when we go in for our second position, our average price is below the support resistance, so that the average price is over here. This acts as a support, and then if it drops below that, we can still get out with a little bit of a profit, because right now we have a profit. It came, knocked us in, it went up, but we want to fill our position because now we're at our accounts at a higher level. So let's wait for it to drop down. We're gonna then get a position on this level, and then we're going to wait for it to go up like that. Okay. Now, if we look at the impact to the other altcoins, right? Let's take a step back quickly. Now, this is a prime example. You can see that it came down, hit this support, and went all the way down. And I've been saying, or actually it was Solana, not Solana, sorry, Radium. At that level up there, I was itching to go long at that point. The problem is though, I could see that at that point, we were up here with Bitcoin. If that flashed down like it did, it would have dragged Radium right through that level, which it did. Okay. And so that's why I held off on that position. And so when that came down, fine, we're not in it. If we want to start looking at a position, we can. But this is why it's very important that we need to be focused and patient and wait for the correct entry. Because if we get it wrong, we can be very, very wrong when we're trading on leverage. I mean, if you look from there down to here, that's a 20% move. It spiked down 20%, which means you probably would have been liquidated even if you're on 5%, 5 times leverage. Actually, you would have been. And that would have just closed out that whole position, and that's it, you're done. So these spikes to the downside are your biggest threat as a leverage trader. All right. and then, okay, actually, while we are on drift, I'll just say, yeah, this is that triangle we've been discussing. Obviously, you get the bears push us down, bulls push us up. We hit this level, we go up and down, keep on using this resistance as it's just stopping us from going higher. But you can see we're eating into the bears, so the bears become less until they break above. When we had this discussion on Friday, we were trading up here. I noticed that none of them, these wicks, were going up above. You had the double zeros that we discussed as well. There tends to be a cluster of take profit orders, limit orders, all that stuff clustered around the double zeros. So that would have added to a bit of resistance, and then it wicked above your support and resistance that was made from these wicks here, and we were waiting for it to come down. So we did enter a position over here at 0.7. That was what we on. So we discussed that on Friday. Now let me just show you something. If you go from here, 0.7 down to here, it's 20% drop. Okay, which means that the maximum amount of leverage we could have used is 5 times. Right? If we had come down here, okay, we'd still been in our position, but we wouldn't have been stopped. We wouldn't have been liquidated. We wouldn't have been liquidated yet. So we had to have a far lesser amount of exposure around this level, right? But what we can do, we can see that it's come down, respected these levels, bounced up. We managed to take our position here. It just touched on it. I mean, we got in. I mean, it really reacted incredibly well to that. We're going to wait for that to come down, and then we're going to go in with the rest of our position size, just like we're doing with Bitcoin, right? So like I said, we had $5 allocated to Bitcoin. We got $5 allocated to Drift because we wanted to get into the position without increasing our total exposure. But now we've got about $20 available to us. And then we will go in, we'll either go into this position, we'll add to this, which we will probably will, or we'll go into some other positions that look like a good setup. But either way, we did not go into our full position at this point, because if it broke through, well, then we're very highly leveraged or exposed to what could have just kept on going, right? So that is a problem. So let's go back to something like GRT. The reason why you have such big wicks that go down like this is actually because of liquidations on your futures market. Okay, so let me just quickly wait for it to refresh. Computer's freezing a little bit here. But the reason why you have it, these kind of, sorry, just losing a little bit of internet here. Sorry, just 1 second. There we go. The reason why we have these spikes that go down is essentially what happens is you got this rising level right now. You got people taking leverage positions. They'll put their stop loss just below there. Okay, so now they're long. To get out of their position, they need to sell. Plus their liquidation might be just below this level here, right? That means that when they're liquidated from a long position, they all need to sell to get out of that position. And as they sell all at the same time at a market order, which means that it just fills that order no matter what, that is what caused that wick that comes all the way down. And this is your biggest threat as a leverage trader, because that drawdown should have been limited to about there. Okay, so you go, oh, 7%, that's all right. I can go 10 times leverage. Not the greatest idea, but let's just say you worked it out like that. You go 10 times, and that means that it'll knock you out or liquidate you at a 10% drop. Just remember, 10% times 10 times leverage equals 100%. Okay, so you always got to look at it that way. If you're looking at 5% drop, then you can take 20 times leverage, because 5 5% times 20 times leverage equals 100. 5 times 20 equals 100, right? So over here, let's just say you went 10 from there, fine, broke through. You see it's not going to go further than this level here. And then all the liquidations kick in. You now get liquidated there. It spikes down, boom, and then retraces all the way back up. Okay, you've just been liquidated. You're no longer in your position and you've lost all your money. So it's these spikes that will be very, very dangerous. Okay, so let's go back over here. Going forward, what we're looking for now, we're going to be entering a position over here. And we're going to keep on adding to this position, and as long as we are above this level. I mean, sorry, as long as we are above that level and below, say here. We just need to make sure that our average position size is below this green line. So you can keep on adding to it. And what you'll notice that, let's say we get into this position. Now, what normally happens during a high volatility event like this? Well, not high volatility, but, you know, a nice little sell-off, is that it'll absorb this drawdown, and you'll have this over here. It'll go boom, boom, and it'll consolidate along here. And then it will start riding this line up like that, and then it will go like that. Okay? And what we're going to do is as we ease into our position, our average is going to stay below this. Our average position size is going to stay below, average entry is going to stay below the support. And then this support is going to rise until we can bring our stop loss up and up and up. So we want our stop loss to be just below this rising support line. And then we see on the 24th of September, over there, that rising line will go through that support, which means that if our entry is about there, it means that around about the 23rd of September, we're pretty much in a risk-free trade because we can put our stop loss, okay, if our entry's over there and that line is pushing the price up like that, we can then get our stop loss, put it like that, somewhere there, okay. Means that stop loss is protecting us from our entry price. So now we're in a risk-free trade. And that line should push us up like that. And the thing is that we've entered, every time we entered the position, we went in until we were fully allocated for that $14. So we've lifted it up from 5 because it's now, we've got the $10 divided by 2 to be Bitcoin and Drift. And so we're going to triple our position size from there to there because we are now, our $30 here is more than 28. And we will not add to that position. We will not allocate anything more than $14 each until we get to 81. Okay? So that means that if we are wrong and it breaks through, we are breaking through at a smaller amount, right? So let's just say or a smaller exposure. Let's just say it goes down and we enter again, but then this, for whatever reason, goes like that. We're going to cut our position over here. We may have entered it again over there, but we can cut it over here just after it breaks through the support level. And therefore, we are minimizing the downside. But if you look to the upside, I mean, happy days, right? Let's look over we're now in long position. So let's say our average is there. Our stop loss is here because it shouldn't really go below this wick here. And we are looking to get to there. We now have a 1 to 6 risk reward, right? But having said that, I mean, I see the top of this channel, so we can kind of keep on this. This can go up to the next one. We're now looking at almost 1 to 10. So great risk reward. And also you minimizing your exposure if we break through by not going all in on this. I mean, this could have kept on going, but if it did keep on going, at least we were the same size as our trade on this side when we were making money. So we didn't lose faster than we were making it. Just a quick review over the other ones. Okay, so we got, okay, so Ethereum, we're hitting some support here. It's obviously bouncing off there a little bit. We want to just hold that position, hold that line over here at 4,000. If it dips below that, well then that could be a bit of an issue. It means that we could go a little bit lower. That will become support turn resistance. So it'll end up going down, up, testing, and then down again. Sorry, my internet's a little bit slow today, so it's taking a while to catch up. Solana, again, it's bounced down like that, but you've got, I mean, you've got the strong support that is now trading above. You've got the rising EMA 50 that can act as support as well. So all things considered, I mean, I think these are fairly good places to buy. I mean, it was better than up here. So these are the kind of situation you want. I mean, let's not forget that when it was up here, we were all going, oh, alts are going, crazy. They're going so well. And we wanted to FOMO in and we wanted to get in as soon as possible because we didn't want to miss out on everything. And we wanted to say, oh, if only it was trading down here at the support again, because it's just blasted through that. And we're feeling, oh, we missed that opportunity. But now it's come back down and we have that opportunity to go long. But now we feel that sense of fear saying, well, I don't want to buy into this market because look at this, it's going down. And so trading is very counterintuitive. You have to kind of step in when there's blood in the streets. And when everyone is getting excited, that is when you want to start taking some cash off the table, right? You want to start just kind of easing off your position somewhat because it could be getting a little bit overheated. So we are in a situation now where we have a relatively good risk reward. I mean, over here, let's see. I mean, it's about 7% drop before I would want to get out of that position, which is not too bad. And also I mean, yeah, you got about 21% gain over here. So if we look at risk reward, if we were just below there, so let's put our risk there, let's put these levels here. And let's say we're going for over here. I mean, if we get in over here, we still got a risk reward of 2, which is fine. I mean, that's our minimum. That's what makes it viable. But if we take a step back, it looks even better because we know that this level here wants to break. See there? This level here wants to break. If it breaks out, that can go higher. We're now going to have a scenario where it goes, if that breaks there, it's going to go boom, hit there, and you're going to have something more like that. And the nice thing is that when it does get above the support or resistance level, it means that you can bring your stop just underneath here. If you're getting at these levels here, that's fantastic because when it breaks through, you can bring your stop loss right about there, and you've capped in, you've kind of locked in all that profit to the upside here. So I think these are good places to get in. But again, also, I mean, having said that, if you're trading spot, like I said last week, I mean, you can get in at these levels. You would not have been affected by this at all. And this looks like it's going to be a good wick for a reversal, and then it can start shooting back up again, right? So I think these are good levels. I'll wait for the dust to settle a little bit, but yeah, I'd be long drift. I'd be long Bitcoin, and maybe picking a few others, having a look where are you at support, are you at resistance. But yeah, I'd be looking to maybe get long. I mean, we are trading on these support levels right now, which gives you a fairly good risk reward. But if it does break below these levels, don't be afraid to get out of your position and make sure that you don't leverage yourself too much so that you don't want to take that hit. If you know that if you put too much leverage on and it dips below that support, you need to be able to let go of that position without any hesitation. You need to be able to just walk away from it. If you cannot walk away from it because you cannot take that loss, I can assure you things can get a lot worse. So you don't want to put yourself in a position where your mind will not allow you to take a hit. If you feel you're going to be feeling that, just rather reduce your leverage. Anyway, traders, have a great week. I'll catch up again tomorrow or the next day, and happy trading. All the best. Bye.